So, which way are house prices going? I'm joined by Cameron Kusher, who's the Chief Economist for RP Data. Cameron, what does your survey say this month?
In February, we saw that capital city home values were unchanged. And if we look across the major capital cities, most of them actually recorded a fall in value. The exception, of course, was Sydney, where home values increased by 0.8%. So it's clear that the strength in the Sydney market continues. The only thing I would say is January and February tend to be months where we see a lot more volatility in the results, obviously because there's a lot fewer sales. So it's too early to say that we're now on a downwards trend outside of Sydney, but it'll be something interesting to watch over the coming months if we see that continuing weakness in those other capital city markets.
So are we going to see growth moderate?
I don't necessarily know that we'll see the growth moderate this early in the year, but we certainly expect that throughout 2014, home value growth generally is not going to be as strong as it was last year. Last year, Sydney home values increased by about 14.5%, Melbourne values are up about 10%, and Perth values are up about 7 or 8%. So particularly in Melbourne and Perth, we don't think that value growth will be as strong there. We do think there'll be a slightly lower level of growth in Sydney than what we saw last year, but obviously the Sydney market hasn't seen much in the way of capital growth for the last 10 years, has limited supply and obviously very strong demand at the moment. And perhaps on the other end of the market, we'll start to see a bit of a pickup in demand from Brisbane because the gap in pricing between Sydney and Melbourne compared to Brisbane has really widened. And that was always the thing previously that attracted buyers to the Brisbane housing market, that it was so much more affordable than Sydney and Melbourne. And that's certainly the case again now.
And what's been driving that strong growth in Sydney?
Well, as I said, values haven't gone anywhere have grown by 2.9% each year for the last 10 years. So when you adjust that for inflation, that's very little growth over a long period of time. Obviously, mortgage rates are at near record low levels. So there's all this level of pent-up demand in the Sydney housing market. And housing is generally seen as a relatively risk-free asset class. And when you can take into consideration the capital growth and the rental return in the Sydney housing market, the total returns from property last year were 19%. So people simply aren't able to get those sort of returns across other asset classes. So it's no wonder they're going into a market like Sydney in an asset class they're fairly comfortable with, like housing, and we're seeing really strong demand at the moment.
Now, Cameron, one of the things your survey found was quite low rental yields, particularly in Melbourne and Sydney. Will that deter investors?
Well, obviously some investors are looking to buy properties to negatively gear, so the yield's not going to be a consideration for everyone. I guess the concern is at some point in the future interest rates will rise, and at some point in the future capital growth will slow. Now, we know that there's a lot of investor activity in the market at the moment. Maybe these people aren't historically property investors. The potential threat to the market is if at some point in the future capital growth ceases or values start to fall, and these people are just left with a really low yielding asset. If they all look to exit the market at one point in time, that is a cause for concern potentially in the future, because that will put downwards pressure on values across the board, not just that investor grade stock. So I think it's something that APRA and the Reserve Bank will be watching very carefully. It's difficult to see how the level of investor activity can escalate much further from here. At a record high level, it was 41% of all mortgage originations back in late 2003, and we're almost at that level now.
Now, given the concerns about a property bubble, is this a good thing, lower growth?
I think a lower level of growth would be advantageous for everyone. Obviously, the Reserve Bank has said that there's a bit of economic rebalancing going on here at the moment, and as mining investment falls, we want to see dwelling investment increase, and we're starting to see a response in the dwelling approvals data, but obviously we know that the CapEx data and the outlook for CapEx is quite poor. So you need a little bit of capital growth to encourage developers to bring these properties to the market. We're starting to see that now, and I think what would be advantageous is a slightly lower level of capital growth. Value growth on an annual basis of around 3 to 4% is probably what our long-term outlook is. Lower levels of capital growth and more construction, and hopefully we get back to that stage shortly.
Is that a worry for the sustainability of markets then, that first home buyers are deserting it?
Well, our data definitely tells us that first home buyers are not playing a huge part in the market at the moment. But if you look at a market like Sydney, for example, the median house price at the moment is $700,000. Now, that's if you're going to save a 10% deposit, you still need to pay mortgage insurance on top of that. That's $70,000. That's quite difficult to save. Obviously, there's more affordable options in areas on the outskirts of the city, or people can look to the markets that adjoin the capital cities to get in at a more affordable price point. But at the moment, it seems that first home buyers are simply unwilling to do that. Also, we've seen more recently in most states the incentives for first home buyers, the grant, specifically focused on brand new housing construction. And the challenge there is that brand new homes are typically more expensive than the pre-existing stock. So it's acting as a disincentive for those first home buyers to enter the market. There's a lot of anecdotal evidence out there that first time buyers are buying investment properties as a first home rather than a house for owner occupation. And although there's no hard and fast data on that, I wouldn't be surprised. But the thing for first home buyers is there's still options available for these buyers, but at the moment, where they're available and the price at which they're available at is not enough to lure these guys into the market.
Cameron Kusher, thanks very much.
Thank you.